thinking about investing in property? Perhaps you don't know where to start. There's so many different ways to invest. HMOs, rent to buy, serviced accommodation, holiday lets, and more. Today, we'll be going through the pros and cons. Hello and welcome back to our channel and podcast. My name is Gemma and here at WS we talk about all things relating to money, mortgages and positive money mindset. So if that interests you, then be sure to subscribe to our channel and hit the thumbs up. It really helps with our YouTube algorithm and means that you won't miss out on any of our videos. On today's episode of Let's Talk Money and Mortgages, we have Itika joining us again. Itika is a trained accountant and mortgage advisor who has been in the industry for over 10 years, and he is also one of the founding directors here at WIS. Welcome back, Ifti. It's always a pleasure. How are you doing today?
I'm very well, thank you. How are you, Gemma?
Oh, very good, thank you. So today's episode is on property investing. Let's get into it. So Ifti, a couple of things. Firstly, let's just talk about, the different kinds of strategies for property investing. What are they?
Oh, there's quite a few. In the past, a lot of people went for buy-to-lets, which was kind of straightforward. But with some of the tax changes, people have become a little bit more adventurous and they've started looking at other areas of buy-to-let. It's more like an extension to buy-to-lets. New novel ideas are coming out now in the market. So it's nice to see that there are some variants apart from the normal buy-to-lets. So some of the popular ones are things like that you mentioned before, rent-to-rent, right? That's a popular concept at the moment. So with that, it's a very beautiful concept because with rent-to-rent, you don't necessarily have to have that initial capital outlay to buy the house. Because as it says in the tin, you rent to rent, right? So you rent out a property from someone to rent it out to someone else. So that's what rent-to-rent does. So usually successful rent-to-rent investors, what they do is they look for people who are like a distressed landlord who is unable to rent out their house, or where there's opportunity where you can split up rooms and rent it out, right? So that's the kind of property they look for mainly. So what they do is they go and find these landlords and say, for example, if the landlord was charging £1,000 rent for a month, they're happy to pay £1,000. But what they do is they take the house and they split up the rooms most of the time and they rent it out room by room, or they rent it out at a higher amount, or they give it to a company, or they do things like Airbnb, and then there's a markup, right? So let's take a simple example. This £1,000 property, say there was 4 bedrooms and they split it into 4 and rent it out separately. They would have made, say, £400 rent per room, which is kind of average. So you make 1,600, you pay the landlord 1,000. Obviously there'll be expenses in between, but you make a margin, right? So that margin is for you, and your outlay is more or less nothing, right? Because you didn't have to put out any money. Because if you bought a house and rented it out as HMO or whatever it is, you would have had to put in a deposit, a 25% deposit to buy the house. So that's not there anymore. So rent-to-rent is a very popular concept.
Yeah, okay. So I know there's a few other different ways. So I think it would be good to kind of go through them one by one. If we maybe start with the pros and cons of flipping, because I know that's quite trendy at the moment, the flipping houses, right, that sort of thing.
Yeah, it sounds like a circus trick sort of thing, flipping, right? But flipping, again, is a popular concept where people buy a house, they refurbish the house, and they sell it on, right? And they make a profit, right? So that's the whole idea. So it's very short term, right? Because with the flipping, everything works very fast. I think that's probably where the word flipping comes as well, because you have to flip very fast, right? So you buy a house, usually you go to distressed properties or properties which seller is really struggling to sell, and then offer below market value, right? That's the key here. So try to get properties below market value. If you know the area is selling for something like 80,000, if you can get a property for about 60,000, you have bought it below market value. So you buy it below market value. Then you do some additional work like refurbishment. If you buy it below market value, let's say the same example, you already made 20,000 from day one because you bought the property 20,000 less than what it was, right? So let's say you spend another 15,000. With that value addition, the property value is expected to go up even further. And you sell it for a higher price, right? So if you do that, that's called flipping, right? So that's the way people make money. So it is a project. It's lovely for people who loves projects, take on a project, do it, turn it around, sell it out and move out fast. Normally flipping projects don't last longer than 6 months, right? At the day you complete, you're kind of ready to start the work, right? So everything is kind of lined up because any day you delay is a cost to you. So therefore it has to be very, very fast, right? So So it's a popular concept that works very well. Your cash flow is pretty good because 6 months time you get the cash back into your hands. That kind of works very well, and your money is not really stuck in the house because if you buy a buy-to-let property, it's stuck for years and years. But here you get the money, right? Only thing is you're continuously working on it. Those are the pros on flipping.
Yeah, and I suppose the con would be that you're under time constraints, right?
Definitely. Yeah, time is definitely money, right? The longer you keep it, it costs you more. And also, it's not always easy to buy a property which is kind of run down at the right price, right? Sometimes people end up spending more than what they should, right? So you have to be a little experienced, so you have to do a lot of research into those areas. So just don't jump into it, right? Because you have to do that, because otherwise that can be a con for you and it might end up being expensive. And also with things like refurbishment, sometimes you don't really know until you start the work how much cost is involved, right? So you can budget for say £10,000, but you might end up spending 12 or 15,000 pounds, right? You have to be very careful when you estimate costs at the beginning. And you have to make sure that you keep to the budget, right? I know you see these things on TV where, people came and made a lot of money and all that. But in reality, you have to be a little careful, right? It doesn't always work in a straightforward way, right? So that can be a con as well. Obviously, I'm a mortgage advisor, right? So from a mortgage side, flipping is short-term projects. Most mortgage deals are for 2 years, 3 years, 5 years. So those are the common ones, right? So you got to sort of look at potentially a lender who will allow you to break the mortgage without an early repayment charge. So you're probably looking at your interest rates might be slightly higher. Or the other option is you have bridging, right? So bridging is a short-term loan. It's kind of for projects like this, it works very well. But again, time is money when it comes to bridging, right? The sooner you get it out, it's easier and it's cheaper for you. Of course, if you have the cash, it works for you as well, right? So with the mortgage side, it can be a little tricky. So plan this properly in advance, because obviously you have to keep your costs low, because that's when you kind of make your margins.
Yeah, I used to love that show, Homes Under the Hammer.
Yeah, I know, it's lovely, isn't it?
Yeah, buying at auction, but they always say make sure you get a survey, and especially if you're going to be flipping, right? You want to make sure that there's nothing seriously wrong with the property.
Definitely.
So the next one, the pros and cons of buying, refurbishing and financing.
Okay, that's very, very similar to flipping, because the only difference here is you're not selling it, right? So you're refinancing it. So you buy, you refurbish, and then you refinance instead of selling. So that's what differentiates that from flipping. So that's kind of what the concept is. Again, it's quite popular. This concept, buying property below market value, is very, very important here as well. For people in this space, they always look at sort of distressed landlords. I mean, don't feel bad about it, because they want to sell the property and they're struggling to sell it, right? So obviously you offer a fair price, and if it's fair from their side, they will buy it, right? So let's kind of use the same example as before, right? So you buy a property for, let's say, £60,000, right? So if it's £60,000, and you get a mortgage, say £15,000 deposit, which is 25% deposit. So you can probably get your family involved in that as well if you don't have the money, because that's what some people do, right? Because some people say buying property with other people's money, right? So you take, say, 15,000 from the family and you buy the house, right? Like I said in the previous example, it's an 80,000 property which you bought for 60. So you've already made that gain, right? Let's say you do a 15,000 refurbishment. So with that refurbishment, let's say the house value went up to 120. So you go back again to the bank and say, look, the house is actually worth 120. Can I do a remortgage, right? So if you do the remortgage, what will happen is bank will say, okay, need 25% deposit, keep 25% deposit. You can take the rest of the money. So you originally borrowed 45,000, but now you're borrowing 90,000, right? So you get 45,000 cash to hand. So you go and pay your family, you borrowed 15,000 for them, you paid some money for refurbishment, you pay that as well. The rest of the money is for you, right? So you automatically sort of gain money here. It doesn't always work like that, but at least if you manage to pay your family off and you cover your refurbishment cost, you kind of covered, right? So you got a property, have 25% deposit, and you didn't spend any money, right, effectively. So that's why this concept is quite important. Very popular again among people. So it's a concept that's picking up. But the key thing is to get the property at the right price, right? So that's the key thing. Yeah. And make sure that you stick to that budget, right? That's very, very important.
Oh, yeah. Okay. Thank you, Ifti. So the next one that we're going to be talking about is the pros and cons for rent to rent.
So obviously with rent to rent, what happens is obviously you're renting to rent, right? So you don't necessarily need that initial cash flow. So that's definitely a thumbs up, because you don't necessarily need the initial outlay to do rent to rent. So that's really, really important pro, right? So that's one of the reasons why people are doing this. And obviously this is a stepping stone for people who are thinking of HMOs, because it's kind of the similar concept, because you rent out a property, then you kind of split out the rooms and you kind of rent it out again. So it's kind of a stepping stone for them. And cash flows are pretty good, and its cash flows are like immediate. You don't have to wait till you sell a property or whatever it is, right? So it's immediate. So in that sense, definitely it's a pro. But in terms of cons, you don't own a property. A lot of people, think of this as kind of retirement, right? At the end of, say, 20 years or whatever it is the term, they hope to sell the property and take the cash out, right? But with this, you don't own property. So there's no bonus at the end sort of thing, right? So it's all sort of as you go is stuff you make. And also, it's difficult to find landlords who will agree to do rent to rent. Some are okay, but some are not, because some say, you know what, I'll just use the traditional route and I'll rent it out through an estate agent. Also, even if you find landlords, some mortgages will not allow you to do this arrangement. So they're quite clear in your mortgage agreement that you're not allowed to sublet out the property for this arrangement, right? So that can be a con as well. So that's something for you to be mindful of. Yeah,
and I suppose if you're renting out the rooms and you have a period where you can't find someone to rent a couple of the rooms, then you'll be held liable for the rent to the landlord anyway, so you could be out of pocket.
Yeah, that's definitely, you could be out of pocket. But a lot of people in this space, they are quite clever because they know the right places to get. But obviously if you're inexperienced, right, you may sort of learn it the hard way. So yeah, you're right, you might be out of pocket if you can't find tenants.
Yeah, so proceed with caution, everyone.
Yes, definitely. Yeah.
And the next one, the pros and cons for furnished holiday lets and serviced accommodation. Popular at the moment, isn't it?
Very, very popular. Definitely, because with COVID, unfortunately, a lot of people can't travel out of the country. And even if they can, they opt not to, right? So they decide to sort of spend their vacations in the UK. So the staycation concept is quite popular at the minute, right? So with that, obviously, furnished holiday lets have become popular. Service accommodation is things like Airbnb. It's very similar concept, right? So the biggest advantage with service holiday lets is the tax advantage. I think we've touched this on our previous videos about Section 24. So with furnished holiday lets, Section 24 doesn't apply. A few years ago, you were allowed to deduct your mortgage interest payment as a cost in arriving at your profit on which you pay tax. Right. So if somebody had a sort of a £10,000 income and they paid £3,000 as interest, in the past they were allowed to deduct that £3,000 and pay tax on the £7,000. But now things have changed. You're not allowed to deduct that £3,000 anymore. So you pay tax on the whole number. It's not on the profit, right? Of course, HMRC gives you allowance which you can deduct. But in comparison, you still pay higher amount of tax, right? So that's Section 24. Now, Section 24 does not apply to furnished holiday lets. So that's the beauty of furnished holiday lets. There are some conditions that you have to meet, but that doesn't apply. And also, when you are thinking of exiting, right, like selling your property, you can potentially claim something called entrepreneur's relief. There are some conditions again. Talk to your accountant. Obviously, we are accountants as well. So, I mean, if you want to talk about this, we are more than happy to talk about it. So you have potential in claiming entrepreneur's relief as well, which is a big thumbs up when you exit, because otherwise you have capital gains you have to pay. Also, if you're selling a property and buying another asset, right, or maybe buying another furnished holiday let, you have something called a rollover relief as well, right? So there are massive tax advantages in this space. So that's why it's very popular. And, obviously Airbnb and all that sort of thing has kind of changed the way holidays are done nowadays. So that is also getting popular. It's mainly because of the tax advantages that people go into furnished holiday lets. And of course, service apartments have very similar concepts as well, right? So that's a nice place to be in.
Yeah, okay, thanks, Ifti. The last one that we wanted to talk about today is the pros and cons of HMO, House of Multiple Occupancy.
I'll explain what HMOs are, right? It's exactly what it says, right? That's where in a house, there are multiple occupants. So usually if you take rental agreement or rental arrangement, there's just one family or, one person living in the house.
Yeah.
But with this, rooms are split up, right? So you will have 4 bedrooms and there'll be 4 individuals living in these rooms. So that's a HMO. So the advantage for an investor mainly it's the cash flow.
Yeah.
Because if you rent out a house, let's say you get £1,000 for a 4-bedroom house, But if you rent out 4 rooms, you're probably going to get 400 into 4 sort of thing, right? That's kind of the average that I see people get.
Yeah.
So 400 into 4 is 1600, right? So obviously there's a massive uplift there, right?
Yeah.
There is a massive difference, and obviously cash flow as well. Because most of the time HMOs, a lot of people pay you weekly, so you don't have to wait till the end of the month till you get paid as well, right? So the money comes more regularly. So cash flow wise, it's really good. Short term, HMOs are really good because you quickly make your money, right? Whereas if you take something like a traditional buy-to-let, your gains are consistent and constant, but you gain when you sell the property with capital gains, right? So that's when you make bulk of the money anyway, right? But with HMOs, you sort of short term, you make those gains as you go. So that's a kind of a huge thumbs up, right? So HMOs are really popular because of that. But of course, don't forget the cons, right? With HMOs, you have to be very careful because you got 4 people living in the house. Take the same example. Nobody's kind of responsible, right? So you probably have to get cleaners in to clean up the common areas. And, there can be sort of issues between tenants. Sometimes you have to intervene to sort of sort that out. There's more wear and tear because people are coming and going all the time, isn't it, right? So there's more wear and tear. And there's more work involved for you as well because you're managing 4 tenants, not 1 tenant anymore, right? So there is more work involved. So there are sort of downsides of it as well. Obviously, like anything, there's pros and cons. You weigh the pros and the cons and see what works best. But for a lot of people, it does work okay. But just be mindful about the mortgage side as well, because with HMOs, generally the interest rates are higher than what you would pay for a standard buy-to-let, right? So just be very mindful. And lenders are a little picky about the type of property as well, right? So you have to be careful. And very, very important is regulation. Because there are regulations around HMOs. There are certain standards that you have to meet. So, your local authorities will get involved in this kind of arrangement.
Yeah, because you need a license, don't you?
Yeah, definitely. Yeah. With most properties, you do need a license. There are 1 or 2 exceptions, but most of them you do need a license. So you've got to make sure that certain standards are met and make sure that the hygiene standards are met. And there's so many things that you have to adhere to as well. So there are those things. But I do have a client who has 4 HMOs, right? And he doesn't do any work, right? Yeah, that's kind of it, right? He doesn't do any work. That keeps him going. It works well, but he considered that as a sort of a full-time job, right? He's quite handy as well, right? He can go and do work around the house, which is helpful if you're kind of having this investment. So there are people like that, which shows that, HMO can work for people for sure, yeah.
All right, well, thank you, Ifti, again for that great advice. I just wanted to put a reminder out there that these points may or may not be applicable to everybody, so please do talk to an advisor if you're unsure if these are suitable for you. If you don't have an advisor, I will leave our contact details below, as we are always happy to help here at WIS. And just a little reminder that as a mortgage is secured against your home or property, it may be repossessed if you do not keep up with the mortgage repayments. Thank you again for joining us today. We'll be back next week with another episode of Let's Talk Money and Mortgages. Stay safe, have a great day, and we'll see you again soon.